Our participants, I would like to call you as the future leaders of the banking and financial sector because you are going to take over the industry in the future. And one of the current leaders in the financial sector, that is our Mr. JPR Karnoratne, who is going to be the resource person today, and also the Assistant Governor of the Central Bank of Sri Lanka, uh, Director of our college, Mrs. Godakande, and also the coordinator of this program, Mr. Menik. Actually, I would like to, I am extremely happy and also consider this as a privilege to talk about to this professional audience and also to introduce our program and also our resource person. Uh, I know that this program, this risk management program is highly demanded program because of the multiple dimensions of risk that the banking sector, especially the financial sector, experiences from time to time. Now, if we take the risk, I don't think that like this period, the mankind has never experienced risky situations like this over a century, I think, according to the information available, because now we are experiencing multi-dimensional risks day and night. During such a period, we are conducting this program. And luckily, even though all these things happen, life has to go on. So we are happy that we were able to introduce this program online so that any participant who wishes can follow the course from anywhere safely. And about the course, I think our resource persons will discuss about the details of the course. This discuss about the theory, different dimensions of risk, and also how to manage them. Therefore, this is a complete course that exposes our participants to all those aspects of risk and also enable them to perform their duties effectively, managing the risk. Let me introduce our resource person. He is one of my very close friends. He is Mr. JPR Karunaratne, one of the assistant governors of the central bank. Because of his multiple qualifications, I can't prevent the temptation of reading the entire list. Let me read it. And Mr. Karunaratne has 29 years of experience in the central bank. Now he is the assistant governor, and he has worked in the bank supervision department, non-bank financial supervision, institution supervision department, public debt, and also currency department, and those are the department he has served. And I remember he was one of the officers who got this CFA. There were very few during that period, chartered financial analyst, and also he has a degree from mathematics, and he has started his academic career in statistics. He also has got a master's degree in statistics. Later on, he has developed his skills in the financial sector. He is a fellow member of the Chartered Institute of Management Accountants, CIMA, UK, and also associate member of the Institute of Chartered Management Accountants of Sri Lanka. He also, in addition to working in the central bank, he has extended his services to the Defense Ministry in the accounting period, this field. And he has been a resource person for the IBSL, Bankers Institute, for a long period. He has been one of the pioneers who introduced this course of integrated risk management. And he is one of the highly rated resource persons, both not only at the IBSL, but also at the CBS and also the universities that he deliver lectures. So I again take this as a privilege of introducing him and also talking to this professional audience. And I think one of the things that you have to consider in engage in this program is when you look at and there will be some other prominent resource persons conducting other lectures, and it will be your responsibility to take the maximum benefit from this investment. This is an investment, and resource persons are highly resourceful, and you have to get the maximum out of them in addition to the lectures they conduct. And because sometimes I see some members tend to lose the enthusiasm over the period, especially when it comes to assignments and all that. If you want to get the maximum benefit, work towards that. And with that, uh, let me invite our resource person, Mr. JPR Karnaratne, Assistant Governor of the Central Bank, to start the program and wish you good luck.
Okay, let me first of all express my gratitude to Mr. Karunathilak for giving a very detailed introduction on myself and also about this program. I think, as Mr. Karunaratne rightly said, this program is highly, valid in today's context. As we know, for the past 1.5 years, we are all running with risk. Okay, risk arising from a very, very much unknown, unexpected event, which we now call the COVID-19. So I think risk itself as an element of uncertainty. When I think during the course of the day we will discuss this. So especially COVID-19 is a uncertainty event, because there are two elements for risk and uncertainty, which is predictable, which is not predictable. So we are living in such an environment. Still, we need to conduct our businesses. There may be slight deviations from the expected path, but still we need to continue. So, likewise, as Mr. Karunathilaka said, IBSL itself has faced with similar risks. So it's not just for bankers; it's everybody in this world, all faced with all these serious risks. Now, from IBSL point of view, how they could, deviate from traditional type of, physical lectures to online lectures, and attract or continue these courses in the best possible way. So I think at the beginning, I think no one had that experience last year, but now with that experience, so they are also mitigating that risk and continue their business in a somewhat comfortable manner. So I think it's a timely topic, even though this is a subject which bankers especially talk of during their, day-to-day working environment, operating environment. So once again, let me thank Mr. Karunathilaka and the team and IBSL for inviting me for take off this diploma program, which I happen to be one resource person. There may be few others from my past experience. So that this is a much relevant course for you all, because if you take, bankers, you always encounter many types of risk. This COVID is something unexpected, but in your day-to-day, business activities, you encounter many more risks. We call credit, market, liquidity, operational, and so on. So managing those risks are important. It's an important thing as bankers, how we can manage those risks and how to continue business, because we can't prevent risk from arising. So we can manage. We can prevent, but not completely. Okay, so our objective as risk managers to mitigate risk as much as possible. So during the course, I think this course has been designed in such a way that it covers all broader risk concepts, where bank or banker face, starting from mainly credit risk, then market risk, operational risk, liquidity risk, and then how different risk mitigations apply, in managing those risks, and then how international best practices connected to risk management, such as capital adequacy and other international standards like liquidity management is being used as an effective risk management tool. So I think the overall structure is like that. I don't think there are any changes. So basically, during my schedule, what I propose today is basically to take you through the very basic introduction to broad risk management. It's a very general topic. And probably I would take up the market risk management part with you all. And then probably towards the latter part, about the capital adequacy framework in terms of risk management under different risk elements. So that my part is basically confined to that, but then the resource person will conduct or take you through other key risk areas, mainly credit and operational risk. So that is the core structure. But few things, as Mr. Karunathalak also highlighted, you want to keep in mind. Now, if you look at following a course, I mean, you can, get a qualification added, behind your name, but more importantly, how you can implement or practice things you learn in these programs in your day-to-day working environment in two ways. One is to, if there aren't any practices already in place, but then you can adopt in addition to improve your existing practices. So that is the most important element, that we will expect from you all. I think mostly, most of you are hopefully from banks, I suppose, because many bankers participate in this program. There may be others, bankers in the sense bankers or people who are working in financial institutions, but there may be others who follow. But generally, from a bank's perspective or a person who is working in a financial institution perspective, very much important the two factors I mentioned, because one is to adopt new technology, new things, in particular to risk management. And the second thing is, if you already have certain, practices, policies, principles in place, to see whether you can grab anything from here to improve yourself. So those are the two key things you have to remember, because at the end of the day, through this education, one thing is to, develop or improve your program processes in your banks, just rather than a qualification. So please keep those two things in mind. And also a few operational matters I want to highlight. Always participate in the classes and the lectures, because now anyway, if it is a physical class, we can see you all. We know much better how you interact, what problems. But even though this is a risk mitigation tool and workable program online, but we don't see you, where the interaction is little less. Okay, you can still interact, but it's little different to physical class. So other thing is, you may be seen here as online, but you are not with the lecture. Okay, so we should not do that. So because otherwise you will lose a lot of things. I mean, each session is connected to the other session, or each day's lecture is connected to the next day's lecture. So try to participate as much as possible, especially these periods. I don't think no one can go out of home, so that especially there won't be any external events that you could participate. Definitely you can devote your time on this subject. So participate in the classes every day, actively participate. The second point, because if you have any problems, clarifications or anything, please do so. Okay, because then and there you come to solve your problems. Otherwise, what happens, at the end of the program, you find it a little bit difficult. And also risk of failing. So that itself a risk. After following a course, after attending a course, and not being able to pass the exam, also a risk. So remember, the risk of passing or failing is, you have to manage through your, other risk mitigation techniques. So the risk mitigations are come to classes regularly, discuss all the workout questions, what we do, repeat those things at home. If you have any problems, please ask, So those are the risk mitigation. Then you will end up with no risk. So that means you can pass the exam. So, so those are a few operational things I want to highlight. So we will try to focus as much as practical context in these particular courses, because these are beyond the traditional IBSL2, exams. So that you will gain much more practical experience. So I think with that, I think probably we can move on to the session today. We'll start the presentation with very basic introduction. Okay. So as already mentioned, what is risk? Does it really matter? So I start with the, very, prominent statement made maybe about 100 years ago, more than 100 years ago. What is risk? Does it really matter? So let's see, why does it matter? So this is a statement made by E.J. Smith. Anybody knows who is E.J. Smith? Anyone? No? Okay. Now, so let's first look at the statement he made in 1907. When anyone asks me how I can describe, okay, let me, before that, okay, E.J. Smith was the captain of the, ship Titanic, okay. So E.J. Smith was the captain of the ship Titanic. Everybody, when you hear Titanic, everybody knows what happened, okay, how many lives lost, including the captain, okay. So when anyone asks me, so he said this in 1907. So what did he say? When anyone asks me how I can describe my experience of nearly 40 years at sea. So at that time, he has been in his job, as a captain and at other capacities for 40 years. I merely say uneventful. So basically what he says is he has not faced any significant risk event. Okay, so his experience was pretty comfortable, good. So he further goes and say, of course, there have been winter gales and storms and fog and the like, but in my whole experience, I have never been in an accident in any sort worth speaking about. So simply he said, okay, there have been winter gales, storms, fog. There were certain events, but never been in an accident in any sort worthing. So it's not worth to talk about accident based on his experience. So he's very comfortable with his experience he had under different circumstances through all these 40 years in the sea. But simply he expressed, I don't see any problem of serious accident. So that's the expectation. I have seen but one vessel in distress in all my years at sea. So he has, during his life, 40 years, he has only seen one vessel in distress. So only one ship has had problems during all 40. So basically what he tries to explain is the probability for something, serious happening is very, very, very low. Okay, almost zero. I never saw a wreck and have never been wrecked. So he has never seen a wreck. Wreck means, damaged ship, shipwreck. No, was I ever in any predicament that threatened to end in disaster of any state. So simply what this statement says is he completely, leave a chance of any serious incident happening. So almost he's put zero. Is gambling on any risk event, serious risk event happening is zero. He may be right because the experience he had was such a way that he had never seen. So it's a 40 years, not a very, short period. It's a long period. If you are a banker, if you have worked in a bank for 40 years, you know what has happened, what events took place, what issues came, what concerns you had, what risks you faced. So definitely, depending on your experience, you can think that the same thing will continue based on experience. Okay? But who knows? Okay? So this is his experience. It matters. So the question was, why does it matter? Okay? Now what is risk? Does it really matter? Yes. Now this is the statement. So answer, it matters. On 14th April 1912, HMS Titanic sank with the loss of 1,500 lives, one of which was its captain. You see? So he made this statement 1907. So the way he made this statement, the chance of a serious event almost zero. But 5 years later, he himself had to face or take this risk with loss of 1,500 lives. So which he would have never expected when he made that statement in 1907. Okay. So it's important thing is, I think it's a good time for us to have this subject in place, like what we experience since 2020, COVID. So in 2019 or 2018, if somebody, even for a joke, said that there would be a disease like this, and it will spread all over the world, and it will kill so much millions of people, and it will continue for so many years, all the others would have laughed at the person who, expecting this or telling this story. Because, I mean, it's like a miracle. I think no one believed, that is a possible event. No one believed. But now, probably, if somebody told, we would have, praised him, okay? If we took that into note, we would have taken better measures. But we just ignored because we thought it's a joke. There is no possibility. In 2003, somebody come and tell you there is a huge earthquake in the Indian Ocean, and probably that could lead to a big waves. He would have not known whether it's a tsunami or whatever to call. But he will tell in simple word, there would be big waves, and big waves will, erode all, these countries, Indonesia, Sri Lanka, India, or whatever, and it will kill so many people. Probably everybody who listened to that person would have laughed. Are you talking nonsense? Better you go to mental hospital and find a bed. We have lived in this world for so many years. We have never heard about it. We have heard about the earthquakes, but we have never heard about sea waves running into about so many feet higher and destroy islands and kill so many people. So people would have laughed at that person. But 2004 December, okay, 26th, I think, this happened. Okay, so that is the danger in risk. But does any of this really matter now? Okay, look at the failures. These are not failures happen locally. Bearings, BCCI, Hoover, Sumitomo Bank, Enron, WorldCom, Parmalat. These are not local failures. These are international failures, international big giants. So what is the reason? Improper risk management. Failure to detect risk in advance and manage them properly. So probably we will look at a few cases later on when we come to the governance structures, how really these risks came and what led to failures in few cases. Well, once we come comfortable with the basic risk management concept, so then you can link. Okay, so that is the reason we learned this. This was the reason. Okay, so it's not something that can happen in a poor developing country, poor nation, underdeveloped country. It can happen anywhere in the world. I think all of these happen in the developed countries. Okay. So what is risk? Risk refers to the uncertainty that surrounds future events and outcomes. It is the expression of the likelihood and impact of an event with potential to influence the achievement of an organization's objective. Now let's narrow down to our organization, because at the end of the day, now risk is all over, everywhere in the world, in our personal life including. But here our focus now, how we can narrow it down to our organization. Okay, our organization. And we develop it from a banker's perspective, financial institution perspective. Okay. So it is uncertainty that surrounds future events and outcomes. Okay, so it is the expression of the likelihood and impact of an event with the potential to influence the achievement of an organization's objectives. Okay, so as a business entity, you have set objectives through maybe your corporate plan, maybe in your strategic plan. So every 3 to 4 years, you set certain targets. You have overall vision, mission, and objectives. Okay, I think all banks have a vision, and overall objective. That's a broad policy. But within that broad policy, you have some medium to long-term plans. Generally 3 to 5 year plans. Okay, so where you set certain targets, certain tasks to be achieved. Now, in simple terms, the bank would have certain targets. So I want to grow my loan portfolio by this much over the next 3 to 4 years. I want to expand my branch network over the next 3 to 5 years by this much. I want to bring in a new sophisticated IT, technology to reduce my cost over the next 3 to 5 years. So there are so many expectations or objectives you need to fulfill over the medium to long term. So based on your expectations, objectives, you set some framework, action plan. Okay. And then you assign resources for that, right? But even though set your objectives, action plans in place, there may be a lot of foreseen as well as unforeseen events that could disturb the process. Some are foreseen, for there are possible events. So even if you set to achieve this much, but there is a possibility of due to a particular action, this may not be achievable to the full extent, maybe little deviation, or maybe complete, failure. Then there may be other unexpected event which you never expected but could happen. So in simple language, this is the possibility that actual outcome deviate from the expected outcome due to several adverse events in future. This exists for businesses as well as in, so it's a common thing, common thing anybody, could face, right? So let's move on to pure risk and speculative risk. Pure risk, what is pure risk? This is a broad classification, a risk for which there is a possibility of loss but no possibility of a gain, right? So this is one-sided risk. So always due to whatever unexpected event, you may end up with a loss. But never if that event does not take place, there is no gain as such. Now, when you talk about risk, you can end up with a loss as well as gain. It may be above the, gain here means above the expectation. If you realize something above the expectation, it is gain. Okay, so it is something above the expectation, right? But in a pure risk event, you cannot gain, but you achieve the objective if everything goes smooth. So there is one side. If something happens, you will end up with a loss. So pure risk arises when the actual outcome of a particular event is worse than the expected outcome and result in a loss to the business or person. So this is also called the downside risk, as the event only results in a loss and there is no possibility of a gain. Okay, so it's a one-sided risk. If everything goes fine, you will achieve your objective. Otherwise, you will end up with or you will not be able to achieve the outcome, and we call a downside risk. Now, classic example is you want to, go somewhere on time, and on the way your vehicle break down. So if the vehicle didn't break down, you would have reached your destination. So it's basically there is no gain as such, but you would have achieved your expected outcome. But here you couldn't do so because of your vehicle breakdown. So only downside risk, pure risk event. Now the advantage of pure risk event, advantage of pure risk event is you can mitigate risk to a certain extent through the risk sharing, which is called insurance. So for example, now you insure your vehicle. So objective is what? If there is an accident, your loss is shared by the insurance agent, insurance company. But if there is no accident, basically, you achieve your objective. So your objective is to run the vehicle without accident. So that is your objective. continue driving for your day-to-day work or whatever without any accident, without meeting an accident. So there is no gain. As far as you don't meet with an accident, you are comfortable. But there is a downside risk. You meet with an accident. You meet, say, your vehicle meet with an accident. Then there is a downside risk. So generally, for pure risk event, you can use risk sharing techniques like insurance to mitigate the risk. Up to the limit, you expect, your loss would be this much. Speculative risk. Now, risk for which there is a possibility of either a loss or a gain. So the speculative risk arises when the actual outcome of a particular event is either better or worse than the expected outcome. See? This is also called the two-way risk, as the risk event could result in either a gain or loss to the business. Right? So a speculative risk is a risk your expected outcome, your actual outcome could be better than the expected outcome or worse than the expected outcome. So both possibilities could happen. Okay. So this is called a two-way risk. So you can end up with even a gain. Now earlier, if the event does not take place, you end up with a loss. But here, if the event does not take place, you may end up with a loss or you may end up with a gain. So these are called speculative risk, especially from a bank's perspective or business perspective. Let's say you invest in a particular financial instrument with the expectation of this much return over maybe 6 months period or 1 year period. But at the end of the 1 year period, either you have ended up with a loss rather than expected return, you have ended up with a loss, or anything above even the expected return. So that's a gain, additional benefit. Okay. So let's move on to the two typical words we talk, risk and uncertainty. So what is risk? What is uncertainty? Is there a difference between risk and uncertainty? So what is risk? Risk has an unknown outcome, but we know what the underlying outcome or outcome distribution looks like. So risk is something about unknown outcome. Very simple example, cricket match. So Sri Lankan team has a risk of winning. So it's unknown. Unknown. Who knows whether we will win or not. But we know what the underlying outcome or outcome distribution looks like. Now, from an analysis point of view, now at the end of the day, as bankers, we look from all analytical perspective. I mean, we put all this into mathematics and financial modeling, even though in simple risk management, we talk all those things. But ultimately, all these are measured through financial models, statistical analysis, and so on. So basically, now from an analyst, he can say whether Sri Lankan team will win or not. We never knows, but if he can have idea of what the outcome distribution, so analyst can say, okay, there is a 60% chance of Sri Lankan team winning, there's a 40% chance of Sri Lankan team losing. So at least there is a certainty. Final outcome we never knows, but we can at least assign some outcome distribution pattern so that we can measure or we can mitigate risk in a somewhat comfortable way. So, okay, the uncertainty, I will explain detail the two things in next slide, but before that, so uncertainty also implies an unknown outcome. But we don't know the nature of the underlying outcome distribution. Okay, so uncertainty also implies an unknown outcome, but we don't know the nature of underlying outcome distribution. Okay. So risk is a state of uncertainty where some of the possibilities involve a loss, catastrophe, or other undesirable outcome. Risk can be measured by considering a set of possibilities, each with quantified probabilities and quantified losses. Now here we bring in mathematics into the risk analysis. Now, as I mentioned earlier, risk is a state of, uncertainty where some of the possibilities involve a loss, catastrophe, or other undesirable outcome. Risk can be measured by considering a set of possibilities, each with quantified probabilities and quantified losses. But uncertainty is the lack of complete certainty, that is the existence of more than one possibility where these outcomes, state, result, or value is not known. Uncertainty cannot be measured by considering a set of probabilities assigned to a set of possibilities. Okay. So can you give an example, very simple example of a risk event? Very simple. Not expecting a financial institution related, but very simple example to justify the statement. Can be measured by considering a set of possibilities, each with quantified probabilities and quantified losses. Can someone tell a very simple example, not related to banking, day-to-day life, to justify the statement? You can take cricket itself. Anyone? Okay, before the start of the match, two captains go to the ground and toss a coin. Two umpires may be there, they toss a coin. So there is a risk. Sri Lankan captain think, okay, I will win the toss. Maybe Indian captain think, I will win the toss. So there is a risk, always risk is there. But there is an unexpected outcome. The actual outcome may deviate from the expected outcome. But we know there is a probability. When we toss a coin, there's a 50% chance Sri Lankan captain will win. There's a 50% chance Indian captain. So we can quantify with some probabilities. So at least some certainty is there. And if you look at historical, data, this can be justified. If you analyze historical data, how many times Sri Lankan captain won? How many times Indian captain won? So somebody would say, okay, based on the experience, probabilities, this is the possibility that could happen. So we know the risk, but it is certain. Certain in the sense we can, now I brought this very simple example, but in your banking life, when you know the risk, when it is certain, at least you know what you need to do. Right? Now, uncertainty. You can never predict. You don't have any underlying information, at least to tell what is going to happen. Now, if you look at COVID, it's a serious example also. At the beginning, no one knew what is going to happen, what to do, because world has never experienced such event. Even vaccines, still fighting. So we don't have much information about successes. So there's a great uncertainty of managing COVID, because no one has any the what you call quantified probabilities, quantified losses, the different variants. So it's a somewhat uncertain event, right? So therefore, risk is always associated with uncertainty, but risk can be measured, whereas uncertainty cannot measure. So the danger lies with uncertainty, not the risk. Because since risk can be measured in terms of probabilities and quantified losses, or based on a possible set of events, we can take appropriate risk mitigating tools as a banker. So you love risk than the uncertainty, but in an uncertain event, you know where to go. Your loss would be significantly high. Surprises. Any organization that has encountered unwelcome surprises or unexpected losses will realize that most were preventable. But one thing, at least if you had basic controls in place, certain things would have been avoided, prevented. Such events will almost certainly have been caused by risks that were not fully understood, or the processes to mitigate those events being inadequate. Okay? So definitely, those surprises or the risk events were caused by that not fully understood, or the processes to mitigate those events were not adequate. So it's a danger. So a general questions one would ask or need to answer. What are the worst things that could happen to us? How likely are they to happen? Are we taking sufficient steps to prevent it? Now, this is a banker should ask, okay, what is the worst that could happen to my profits, my financial condition? How likely they are happen? So you have to identify what are the worst things. Then you have to assign probability. What is the chance of this happening? I mean, just because you identify things doesn't mean everything happens to you, but there's a possibilities. Then, are we taking sufficient steps to prevent them? So these are the questions you need to answer from a risk perspective. Now, this is very right in present context. So worst thing in the let's say for an individual happened to me. So what is the possibility happening? Then what steps we should take? So depending on the possibility, the steps you should take is quite different. Now let's say a particular risk event, the possibility of happening that event is, let's say, 20%. Only 20%. So it's a very little probability. But for the same risk event to another person, there's a 80% chance of that happening. So the natural question you should ask is, am I having sufficient measures, steps to prevent them, or at least to mitigate them? So what you need, greater transparency in conducting your businesses, better governance structures linked to the risk management, better ethical standards, always install good practices, ethical standards, need for early warning systems to detect any problems in advance. It's very important. It's like a disease, it's better to prevent rather than cure. So have some systems in place, warning signs of particular risk event, so that you can take measures in advance. Demand for higher quality services, new legislation to combat certain unexpected events or risk management, system reform, project management. Okay, so you need to restructure your systems, or new ways of managing projects to mitigate risk events. So let's move on to the classification of risk. The risks are generally classified according to their source or characteristics. However, there is no standard or established system of classification. Therefore, you may come across a variety of risk classifications. Company-wide risk can be divided into two broad categories: business risk and non-business risk. So generally, risks are classified according to their source or the characteristics, but there is no standard definition as such. I have highlighted some way, but if you look at a different textbook, you may find it a little bit different. So there is no standard way say that, okay, this is the way that you should classify risk. But generally, there is a common way of looking at risk, common classification criteria, but those are not like standards. If it is a standard, everybody must comply that standard alone. So broadly, from a business perspective, you have business risk and the non-business risk. So what are business risks? What are non-business risks? Now, if you look at business risk, you have product risk, macroeconomic risk, technology risk. So why we call business risk? They are arising from the nature of the business. Within the business itself. Non-business risk, the two broader categories, event risk and the financial risk. Now, if you look at event risk, possible risk, we could consider legal risk, reputation risk, disaster risk, regulatory, political risk. Then financial risk, market risk, credit risk, liquidity risk, operational risk. Now, this is a general classification. Now, if you look at a financial institution like a bank, financial risks themselves are their business risk. Now, for a normal business entity, financial risk is a non-business risk. But if you take a bank, these risks are your business risks. Because the nature of your business is granting credit or lending, investments, managing liquidity. So that these risks are part of your business risk itself. So what is important is business risks are generally the risk faced by the business, inherent to the business. depending on the category of business, certain normal non-business risk may be a part of business risk in such business organization, right? So the event risk, legal risk, reputation risk, disaster risk, regulatory. So these are few, but there may be in your business organization. You can, name whatever called risk. Okay. So generally, broad financial risks are market, credit, liquidity, and operational risk. It's a broad financial risk. So business risk. Let's start with business risk. Business risks for an entity are those risks arising from the nature of its business and its operation and out of business conditions. So it's arising from the nature of business and its operations and out of business conditions. So the business risks are speculative risks since they can create both gains and losses. So the major business risk now, these when I talk here, I am talking in general term, general business organization. Okay, so these are very useful risks when you analyze a customer. Now, if somebody comes to your bank and asks for a loan, in your analysis, these are typical risks you should look at from a business perspective. So now he is asking me 100 million loan. So usually you look at all other financial analysis, but what about the business risk? Product risk, macroeconomic risk, technology risk, and so on, inherent to the business operations. So let's look at one by one. Product risk arise due to loss of demand for products and services of a company due to various factors. The demand may drop due to development of better products by competitors, poor quality, inability to cater to the latest styles and needs of the customers. So when a customer comes to you and asks for a loan, I know most of you love to look at the financials. The first thing you ask is, what about your financial statement, annual accounts? Okay. Right? So you love to look at, you do the profitability analysis, you do the liquidity analysis, all those gearing, everything. But what about the historical financial information may be all right. But the future business risk the company pays may be quite different. Right? Quite different. So that you need to take that into account. Now I am looking from a banker's perspective when you're giving a loan. Or even when you make an investment. Now say you plan to invest in a particular company. Financials look sound. But you see, for example, let's take example of garment manufacturer. Say listed company. Okay. Now you want to, that particular company comes to you and asks for a loan. Let's say 100 million. Historical financials looks fine. But now there's a news coming, or the news has been there. For example, GSP plus. So there's a risk of Europe not extending the GSP plus. So if the GSP plus is removed, of course we know then we have to compete, because as a result of GSP plus, our products are less taxed. We get a tax concession so that the importers from that 10 get at a lower price, and in return they sell in their markets at a lower price. So we have a competitive advantage. over other products. Sorry, other suppliers maybe, that who have not got any tax concessions. But let's say Europe has told the government, okay, these things will not happen, then we will remove. So there's a risk. So let's say government is not willing to do that, then maybe next 1 year period, they say, okay, we will take out GSP plus. So that definitely our products going to those markets will be affected. So in your analysis, you looked at financial, comfortable. Have you looked at the risk of such event? No. So it's very important from a business perspective. Now this is, I am talking general, but this is also very relevant your credit risk perspective when you analyze your credit risk of a customer. But for the business itself, this is very important. How my products are going to be sold in the market? But who are the competitors? Are there any good quality products? Is it with latest style? Now another reason is, now when it comes to certain products and services, the style is important. So you need to continue with different styles. You lose the market. So you have to tap the market with the changes. Technology also, we will explain when it comes to technology. So this is a significant risk. Macroeconomic risk arises due to unexpected changes in macroeconomic conditions. Business of a company can suffer due to recession in the economy with lower demand for goods and services produced by the company. Now, this can happen, in any business and for any business entity. The overall macroeconomy, the macroeconomy is poor, then definitely there will be less demand. So with that, prices come down, so sales will come down, so that your bottom line will be affected. So you want to ensure macroeconomic risk. Internally and externally. Now externally also, now due to COVID, certain industries was affected last year significantly. Okay, because of significant economic crisis, business failures, especially the export industry. So you have to analyze the macroeconomic risk. Now COVID is an extreme case, but in general terms, even under general environment, you have to see. Technology risk arises due to changes in technology affecting the type of products or services offered by a company and failure to adapt new technology. The banks which are not capable of adopting new technology such as internet banking, phone banking are subject to technological risk, resulting losing its customers and competitors. Now today, world is changing. So world is moving from less technology to high technology. Everywhere in the world, whichever industry you talk of, lot of technology improvements have taken place. So you can't survive, especially when, because people look for, comfort now. Now, for example, take a very simple example of auto industry. Auto industry. About 20 years ago, we used to drive manual vehicles. But then some companies went for automatic vehicles, automatic gear vehicles. So if, let's say, when the others, because then people are a little comfortable. So people look for comfort. And then people move from manual gear system to auto gear system vehicles, so that demand for manual gear vehicles comes down. So let's say you are a manufacturer of manual gear vehicle, then definitely you will have a significant risk of losing business unless you adopt change. Unless you adopt change. Now this is a reason. Now, for example, now if you take Indian market, of course, Indian market, the manufacturers can still cater to India because there is no problem compared to the population. Still, they run with so much manual gear vehicle, but they can cater into the Indian market. But problem is, when it comes to export market, they find it a little bit difficult. Okay. So you have to move it in. Now, for a bankers, it's very important, especially today's context. If you don't provide technology-related facilities, definitely customers will move away from your bank. So the people expect more comfortable service. So it is very important from a business perspective, look for changes in technology, adopt those changes to suit your business environment. Because there are the two things that can happen, the competitiveness and maintaining the business. Other thing is cost. Because many businesses today have reduced their cost significantly through technology. So that is the other factor. So that benefit can be passed on to the ultimate customers. So that you can maintain your business at a much more comfortable level with a lower cost. So that is the other part of the equation. So those are broad business risks which applies to any body, whether it's a manufacturing organization, whether it's a bank, whether it's a trading organization. Because product risk, even from a bank, there are a lot of products. You sell different loan products, different deposit product, and so on. So again, very important. Now the different banks have different products. So that some customers love for certain products because of the comfort they have. So they gradually move business from doing banking with your bank to other bank. Because customers look their comfort. In macroeconomic risk, the technology is very important risk for bankers. Right? So non-business risk. Are there any questions so far? Anything you need to clarify? Hope all of you are with the lecture.
Sir,
Yes.
this is regarding this macroeconomic risk. This may be one of the reasons we have to look at the moratoriums. No, sir. Again and again, this is continuing. No.
Yes.
So that risk also coming under this macroeconomic level because of recession and works are not there. People are requesting repeated moratoriums
Yeah.
to. That also may be coming under
I think we can, rather than a macroeconomic risk, I think we can call it a event risk. Now it's a result of a unforeseen event, COVID.
Yes.
Because of COVID, this moratoriums came. So this is sort of a, it's not rather coming from macroeconomy.
Okay.
Due to the economic problem, the problem arose as a result of event risk. Probably we can discuss on the event risk. Okay? Event risk which led the businesses in the banking industry, I mean, all businesses affected. As a result, banks were asked to give a moratorium. As a result, you are facing credit risk now. You see, event risk has now converted to a credit risk. So that is the linkage. Now, macroeconomic risk is like a fundamental, now in a normal circumstances, how many macroeconomic factors that could lead to a risk of a business. So there is a element of macroeconomic problems as a result of COVID, this particular moratorium, but it's basically a sort of event risk.
Okay. Okay. Thank you.
right? Okay. So let's move on to the non-business risk. Financial risk arises from factors external to the business and of a financial nature. Many of financial risk are speculative risk. Because if you look at most financial risk are speculative, especially the market risk. Okay. Especially the market risk. Right? Then event risk arises from adverse events that are either internal or external to the business organization. So most of these risks are pure risk or downside risk and might be possible to minimize by obtaining insurance. Now, event risk mostly can be covered through some insurance. Mostly, but not all. Okay. So let's look at financial risk. So this is very much related to your businesses because these are part of your business risk as well. We call it financial risk from a general perspective. Now, credit risk also refers to the default risk. It's the risk that debtors of a business fail to pay their dues to the business in full on time. Okay. So as you know, failure to honor the loans obtained or obligations due to the business on time in full. So this is typically the largest risk in many banks in Sri Lanka. This is the largest risk because most of our banks, the key product is the lending, key asset is the loans and advances. Then market risk. So I am not going to discuss all these things in detail because there are different sessions under this course, different modules covering these things in detail. So there will be a separate detailed credit risk module so that you will have a greater understanding, but just briefly, credit risk, market risk. So market risk is the risk of the changes in market variables such as interest rates, exchange rates, equity prices and commodity prices, which will have an impact on value of assets and income of a business entity. Market risk has 4 components. So basically, as a result of fluctuations in the interest rate, exchange rate, equity prices, commodity prices, there could be a possible impact on value of the assets and income. So we call market risk because these are market variables. You don't have any control. No one has a control on market interest rate. You see, say banker's perspective, you don't have any control. Okay, the interest rates will go up and down depending on certain circumstances. You don't have any control on exchange rates. That again depends on external factors. So you don't have any control on equity prices or commodity. Now, if you look at, if you are an investor or investment in gold, you don't have any fluctuation. Price ups and down. It's very important. But as a banker, you must identify the risk and you must mitigate the risk to the most possible extent. So these are the 4 risks. Again, now we are not going to discuss in detail here, but briefly we will look at foreign exchange risk is the risk of change in value of foreign currency position due to change in exchange rate. The risk depends on the nature of the foreign currency position. If a bank has a long position in US dollars, appreciation of US dollar against rupee will result in a gain to the bank, while the depreciation of US dollar against rupee will result in a loss to the bank. Right? So I think this is the typical risk you face today. the fluctuations of foreign exchange, depending on the position you hold. Now, if you have a long position, so that means long position means you have overbought position. You will learn in detail when you hear to the foreign exchange risk part. So then appreciation of US dollar or basically depreciation of rupee will benefit you. Similarly, if you have a long position, depreciation of US dollar or appreciation of US dollar, rupee will end up with loss. So the exchange rate fluctuation depend the loss due to the exchange rate fluctuation depend on the position you hold. Sometimes it's not always bad. You see? If you have a long position, then depreciation still benefit you, right? Then interest rate risk. So the interest rate risk is the risk of change in market value of interest sensitive assets and liabilities due to change in interest rates in the market. So change in interest rate also affects the net interest income of an institution, right? So whenever market interest rate on which you don't have control goes ups and down, your assets and liability values and the business income will be affected. So that is called interest rate risk. So there's a full session on this, so we will have a better understanding when we discuss that. So if a bank has a portfolio of treasury bonds, in its asset, value of bonds will decline if interest rate rise, and value of bonds will increase if interest rate decrease. So if you look at last 1.5 years and maybe almost 2 years, close to the 2 years, if you are holding bonds, treasury bonds in your portfolios for trading purpose, have you end up with a gain or loss last 1.5 years? If you had held treasury bonds or any bonds, marketable bonds, in your trading portfolios, have you end up with making gains or losses last 1.5 years or so? Anyone share your experience? Anyone, any thoughts? If the banks, you have trading portfolios in treasury bonds, so what would have happened? Or maybe what is your experience? Of course, we couldn't have a discussion with each one of you about where you work and experience at the beginning, like what we do, but we'll do it after the break, so that at least we know from where are you coming and your experience. Anyone? Any thoughts?
I think, sir, there's a loss of.
Made losses. What is the reason for losses?
Due to the bank rate interest rate low.
Sorry?
Interest rate low.
Okay. Losses due to interest rate low. Any other thoughts?
Sir, this is government-backed securities, so I don't
Yes.
feel any losses or gains as determined
I'm asking
gain.
from an interest rate perspective. You are talking about credit risk.
Oh,
Here the interest rate now, your government-backed securities, you don't have a credit risk. But if you hold it for trading purposes, then market risk is there. The market risk, interest rate risk, right? So if you look at last 1 year or so, what do you think consider the prevailed environment? If you had held treasury bonds for trading portfolio, I am referring to trading portfolio, right? Not the investment portfolio. Now, what was the
So,
interest rate environment? Yeah, somebody want to
yes,
go.
just I'm not sure whether I'm correct or wrong. I think we have gained it because if the interest rates are low, when the bond values are high, when we're trading it, we will sell for the higher value. In that case, I think we have gained it. I'm not sure whether it's correct or wrong.
Yeah, okay, correct. So if you look at last year or so, especially 2020, we saw continually interest rate came down. The policy rates also came down significantly until I think couple of maybe last week or maybe week before, I can't remember. Yeah, week before when the policy rates went up. So the 2020 experience was a continuous reduction of interest rate, market interest rate. So in a market interest rate reducing environment, definitely your values will go up, bond values will go up. So if anybody, I don't know whether any of you working in a treasury department of your bank, you ask your friends what happened. You would have won thumping profits because the prices went up, interest rate came down, prices went up, so you would have sold and realized the gains. So in a declining interest rate environment, if you hold, bonds in your portfolios, it could be treasury bonds, it could be other marketable corporate bonds, you will gain. So that's why if you look at, are there anyone from primary dealers here? Any primary dealer, anybody from primary dealers? Companies? So if you look at primary dealer company, or even if you are a primary dealer unit of your bank, you will see you would have gained somewhat good. All the primary dealer profits went up because of these substantial gains. But now this would have a little bit reversed now because there may be a tendency to interest rate go up, then probably the things would have been reversed because then probably if you had bought at a very high prices, very low prices, very low interest rate, and when it start picking up, your prices may come down. Okay, so then there is a risk of interest rate. So there is interest rate risk of you will forgo certain component of your income and the negative market value effect. So we will discuss all this in detail when we discuss the interest rate. But basically, so this is something as traders you should look for. Okay, so if you work in a treasury department, primary dealer unit or whatever, you will realize this. So interest rate is very important from a bank's perspective because that one is the trading part, other is the mismatch. You see, of the interest rate sensitive assets and liabilities. So I'm not going to discuss in detail, but keep in mind. So I will take you through interest rate risk probably very soon under the market risk. Equity price risk. So this is again another component of risk, market risk, change in market value of shares held by a company when share prices change. If prices of shares in a portfolio increase, the market value increase, and if prices decrease, market value of portfolio. So this is the opposite. So if you have a portfolio of equities in your trading portfolio, then you are subject to risk when the price goes ups and down, right? Commodity price risk is the risk of change in value of a portfolio of commodities held by a company due to change in commodity prices. If the prices of commodities in a portfolio increase, the value of portfolio will increase, and if the prices of commodity decrease, the value of portfolio decrease. So classic example is, now if you take, I don't know whether Sri Lankan banks do trade in commodities, but many international banks, especially like commodities like gold, they do gold trading as a part of their commodity portfolio. Even certain banks, even other international commodities, they do trading. Okay. So then if you hold a portfolio of commodities such as gold, then gold price fluctuations will have an impact on your market value and the income, right? Okay, so let's move on to the liquidity risk. Another financial risk refers to the inability of a business to meet its immediate obligations of its creditors. Liquidity risk has two aspects: the asset side liquidity risk or the liability side liquidity risk. Okay, so this is again a very important risk from a bank's point of view. We will discuss in detail, but for the time being, it measures ability to meet immediate obligations of depositors and other creditors. So it can arise from two sides: one from asset side, other one from liability side. So liability side liquidity risk arises when a business is unable to meet its maturing obligations of creditors and the depositors. Then asset side liquidity risk arises when business finds it difficult to sell its marketable assets at a reasonable price. So it could be from, now usually when we talk about liquidity risk, we just talk about one element, meeting the obligations, that is on the liability side. But even asset side, if you don't have adequate liquidity to realize those assets, then again liquidity risk could arise from your marketable asset side. You are not in a position to dispose those assets at a time of need to meet your obligations. So this arises when spread between buying and selling increases. Then operational risk is the risk of loss resulting from inadequate or foiled internal processes, people and systems, or from external events. Operational risk can arise due to failure of internal systems, inadequate internal controls, fraud, or theft by an employee, or due to an external catastrophe. So again, this is somewhat, now if you look at credit risk, market risk, liquidity risk, you can quantify with a reasonable assurance. But if you look at operational risk, one difficulty is the banks don't have much adequate, comfortable databases. Because these, if you look at historical events, are very minimum, even not recorded properly. So that is why when it comes to operational risk, it's very difficult to quantify because of the lack of adequate databases. But if you look at credit risk, you have ample data for loans given, defaults, different sectors with defaulted, so a lot of data. Then you have a lot of data about liquidity risk, which is liquid assets, liabilities, emergencies, and scenario analysis, which you have done with respect to liquidities. Then even market risk, trading patterns, prices, foreign exchange rates, fluctuations, equity prices, all those, and how those affected your assets and liabilities. But when it comes to operational risk, the data is not that much available. And banks would have built up databases since the Basel Capital Accord introduction, but Still less, because these are not significant. I mean, operation risk events are not taking place every day. But if you look at credit risk, there could be a default every day. So loss arising from inadequate or failed internal processes, people and system, or from external. So internal as well as external events that could lead to loss to the business or the bank. So it could be due to the failure of internal systems, inadequate internal controls, fraud, or theft by an employee, or due to a completely external catastrophe. So let's look at the event risk little in detail. So the possible event risk, the legal risk, risk of possible legal action by different parties against a business for various reasons, such as environment pollution, poor quality products, violation of consumer rights. Okay. So these are possible things, events that could lead, business to face significant risk. Now, there may be, for example, there may be some chemical wastage, which is found near, residential area. You see, so there may be legal, due to, maybe environmental pollution. The people may challenge the business operations and take legal action, claiming damages for their health, risk. So this is a particular due to particular event, this legal risk could arise. Then reputation risk, the risk of lost reputation due to factors such as poor customer service, provision of inferior products and services, and other weakness. Now, so this is again a serious risk because business perspective. Because if you lose your reputation for such reasons, then definitely regaining your business is very difficult. Because definitely, regaining is difficult especially if you are in a competitive business environment. So you have to be mindful of reputation risk. I think if you look at a few years ago, significant reputation risk as well as legal risk for one leading business organization in Sri Lanka. Because to some, product qualities and maybe problems. Can anyone think of one very prominent business groups in Sri Lanka? But of course, in Sri Lanka, people only mindful of for few months of any negative thing. Thereafter, they, do business. After a few months, they forget everything. So the reputation risk or legal risk won't be there for much longer. But generally, but in other countries, these are serious. I think can anyone tell? Or can remember about maybe 3 to 4 years ago, as I can remember. Even people refuse purchasing such products. Can anyone think of? No ideas? Maybe about 4 or 5 years ago, I can't remember. So Anchor, if you remember Anchor, about 4 to 5 years ago, there's a serious issue with regard to product, ingredients, contaminated, some issue. Remember 4 to 5 years, so everybody refused to purchase Anchor products, remember? Okay. So then it took some time to regain, but no one worries now. Okay. So that's the Sri Lankan nature, but it can cause significant losses to a business, operations as a result of reputation risk. So you have to be mindful. Now, in certain countries, now legal risk is very significant. Now, even a small inferior product, some customers sue for millions and millions dollars, euros, such institution. Ultimately, they end up even making themselves bankrupt when these, legal claims are made or honored. So these are significant event risk. Disaster risk, also part of operational risk, which affect business activity as a result of unexpected catastrophe. Now, I think we can include COVID also. It's a disaster. It's flood, fire, earthquake, COVID. So, I mean, unexpected disaster, okay, which no one knew, which no one can, predicted. So that significant part of operational, external event, you see. So disaster risk. So now if you look at moratorium, all led, all this COVID led these things to happen. This ultimately end up with a credit risk. But as a result of this disaster arising from the COVID, okay. Then regulatory and political risk arises as a result of introduction of new laws or regulations by government and regulatory authorities affecting certain aspects of a business, and changes in laws and regulations are usually high at times of political instability or change in political party. Now, this is again important. Now, from a business perspective, suddenly unexpected, changes in political fronts in some countries and their different policies will suddenly lead to significant risk. Okay, or some regulatory, new laws by the governments or the regulatory authorities. Okay, now for example, now in the recent past with certain controls on imports, so certain business sectors, if you look at the vehicles, okay, due to some new laws, new restrictions, that industry is significantly affected, and in turn other industries as well. So the risk is not just for the one industry, one business group, but it has emanated to another business group. Can you tell who will be subject to the risk arising from that, other than the people who did, engage in auto trading? Who are the others? Anyone? So there's a direct impact on these businesses who were in the auto trade. But what is the second line impact? On whom? Any thoughts? Can someone tell? It's very simple.
Those who involved in the spare part businesses linked to the motor vehicle spare parts.
Yeah, that is again a little bit related, but totally different business, but affected due to this.
Mainly importers who are in the trading activities. Because the import
Importers
is controlled.
Sorry?
The other non-essential importers who have been in the import industry.
Sorry, I couldn't other.
Non-essential importers.
Rather than there is a specific group affected. So direct and then connected. You are the people affected, bankers and finance companies.
Interest rate?
Banks and finance companies. Now if you look at finance companies, their major business is leasing, right? So they don't have any leasing business now. So significant impact now, especially the banks, at least they don't have much leasing product. But the financial institutions like finance companies who were engaged in leasing business and lending on auto vehicles, okay, so their business has significantly affected due to these restrictions, So see, the risk arising from one particular business entity could, regulatory and political risk could lead to several industries. See, direct and related. Okay, so that's important. So the event risks are sometimes so dangerous, especially now. For example, now in certain countries, no one would like to invest even in certain countries, because suddenly changes can even stop taking your investment back. You see, due to political, now let's say in a particular country, totally different during a political change, totally different ideological change in changing thinking government comes. Suddenly, maybe they ban certain things, So then what happens? So even you can't take it. So that's why, when even in, when people investing in countries, they look at these things. What are the potential risks? Whether there would be restriction on my investment, income, and so on. So very important from a business perspective, how these changes take place, and what measures you need to take in advance when you see potential risk. Sometimes you can't predict these things, but at least when you see, you must have now, of course, financial institutions need to diversify their business from, concentrate rather than concentrating on vehicle, financing to other areas. You see, if you look at now, if you even in your banks, if you have significant high lending to tourism sector, then again problem. Okay, because of these certain unexpected events. You see, so at least then if you are diversified, then you are comfortable to some extent. Okay, so these are part of your risk assessment when you do the risk analysis. Okay, so let's move on to the risk management. So what is risk management? It's a process for identifying, assessing, and prioritizing risk of different kinds. So it is a process identify, assessing, and prioritizing. So once risks are identified, the risk manager will create a plan to minimize or eliminate the impact of negative events. A variety of strategies is available depending on the type of risk and type of business. So when you identify, then you have to assess them and prioritize. We will look at them in detail. So as a risk manager, your objective should be to, if possible, to eliminate or minimize. Because in the many risks, it's not possible to eliminate at all. You are lucky if you can eliminate at all. But in a business environment, if you think of a complete elimination, it's little bit, impractical. But your objective is to have a plan to minimize. Okay, you identify the risk, so this is possible, and this is the impact that is going to happen to my business. But let me have some risk management mechanism to minimize it. So that's the basically broad objective of a risk management, team or risk management of a business entity. So it's a circle. So this is continuing throughout the business cycle: identify, assess, and analyze. So you have to first identify. So what are your risks? Because even if you are in the same business, your risks are quite different to somebody else. Okay, now take example of two banks. Okay, so the banks are in same business, but the risk may be quite different in the two banks. So because of maybe one particular risk is in bank A, simply one cannot say, bank B also face the similar risk in that extent, right? So you must identify. So it's your own individual assessment. Then you assess the level of risk and analyze. It's basically a sort of a quantification. We will look at it. Then plan of action. So that is how you are going to mitigate the risk. So what is the action plan? What tools you create? Then let the event take place and monitor. Implement and monitor. Now you take the action and monitor. So after the action plan, how it is going to affect your business. Then adopt again control measures. Whether sometimes your action plan may be successful, may be not successful. So you have to monitor, measure and control. So if you see certain actions are not maybe successful, then you have to come up with new actions. Okay. When you see certain risk you assets are not materializing, then you can forget about those risks, because the cost of risk management is significantly high. In theory, we can simply call, manage risk, but manage risk is not at a zero cost, remember. It's not at a zero cost. Now take your vehicle. You can tell manage risk. How do you manage risk? With an insurance coverage. Today, if you have let's say 10 million worth vehicle, how much you have to pay? Maybe a couple of lakhs you want to get a full insurance. So it's not free at a cost. So that's why you must identify the risk at prioritized basis. Most important, highly impact, so that you must manage. Now think of a very old vehicle you have. Maybe still, even in Sri Lanka is the only market, even 20-year-old vehicle is going up price 3 times the price above that 20 years ago. The only country in the world. So 3-year-old vehicle, some 10-year-old vehicle, you hardly use it. Maybe your second backup vehicle. Maybe let's say it worth maybe 1.5 million or whatever. You hardly use it. Probably you may go to the shopping mall or supermarket once a month or so. Which probably you may not have a significantly high insurance for that. Considering the possible likelihood and impact. But of course, the vehicle you go to office every day and used to travel for most of your purposes. Even the value is less, it's better to insure at full value. The potential risk is very high. So prioritization is important. Once you identify the risk framework to the measures, and then to have the controls in place, prioritized basis, right? Okay. Are there any questions?
Sir, I just want to find out for the now its present level, there is a country downgrade, is there? No, is that be considered under the microeconomic risk or under the event risk? It will be.
It's basically, if you look at, it's a sovereign risk. Downgrading is a sovereign risk. Okay, so the sovereign risk arise due to problem macroeconomic fundamentals. The outside agencies consider. Okay, so how they look at on our macroeconomic front, right? So that's basically sovereign. That's part of from a country's perspective, it's a measure of country's credit risk, right? Country's credit risk based on macroeconomic considerations assessed by those agencies. But if you take a bank's perspective, that will lead your entity is also subject to certain negative credit risk. You see, that is individual entities. Okay, so it's sort of a sovereign risk is related to credit risk, country's credit risk. Okay, but underlying basis is macroeconomic conditions they think not good, right? So from your point of view, it would have a risk on many fronts. From individual institution perspective, especially a bank, you may have problem with your own ratings by those agencies. So it will affect your lending borrowing rates, maybe your international banking correspondence, and so on. So it is a measure of credit risk of a country, country. So that is measure of country's credit risk, like a credit risk of your bank. So in turn could have impact on individual ratings of individual, especially the financial institutions. Bank. But that decision would have to, I am telling that decision is right or wrong. Okay. So probably the government is still thinking that is not right by them, those parties. But if you set aside that, so that the decision would have taken by those parties taking macroeconomic fundamentals. They think not fit, right?
Excuse me, Mr. Arnold. Just a question on that treasury bond subject which we discussed earlier. You said that there were like banks were making a lot of profits from those treasury bonds. So is there any connectivity between this central bank increase in the SRR is recently by 2%?
Of course, now you have now if you look at the interest rate, there are a couple of things. Now, market interest rates are related to the policy rates. Now, recently, you all know policy rates also went up by 50 basis points, right? So it was earlier SLDR was 4.5% and SLFR was 5.5. Now it went up to 5 and 6. So there's a 50% increase in policy rate. So policy rate is the indicator of the market rates. So whenever a central bank in anywhere in the world raises policy rates, that adjustments will take place in the market interest rate. So naturally, market interest rate will also move upwards in different basis points, maybe lower than the policy rate increase or higher than the policy rate increase on both sides. It may be parallel shift, it may not be parallel shift. So basically, market interest rates are related to the policy rates. Then if you look at SRR is basically rather than what you call policy rate, market interest rate measure, it is basically to adjust any inflationary expectations to mop up liquidity in the system, right? Because when a system economy is running with, without any inflationary pressures, then naturally a regulator, central bank would decline to bring down policy rate, the SRR. So that the banks can keep more cash in their vaults. I mean, basically they can hold more liquid money. When SRR increase, it is rather usually measure of managing or mop up liquidity so that expectation of little bit inflationary. Okay. So the SRR complete idea is that. So that to tighten the liquidity. Reduction will lead to relax the liquidity in the banking system. Increase is due to tighten the liquidity so that there may be expectation that probable inflation compared to the current inflation means not extreme high inflation, but gradual pickup to control. This would have been brought in as a monetary policy measure. So the SRR is basically monetary policy tool, either to expand the liquidity in the banking stock or contract the liquidity. Now here contraction through the increase. Okay, so that there will be much more control on the credit front. Right? But that gives a signal. From your perspective, you have to identify signals. Okay, what this gives you the signal? Now, for the last so many, maybe almost nearly 2 years, I can remember, it was a declining criteria. So as I said, if you hold the trading portfolios, you would have gained billions and billions. I don't know anyone of you work in a primary dealer unit of your bank, you would have looked at, if you had trading portfolio, you would have gained as much as possible during last, especially 2020. Now this year it was somewhat at a stagnant level. But now, signal given, rising. So then you as risk manager need to factor that into risk management. You see? So this is very important. Now your purpose is not just the event, either increase or decrease, how it affects your portfolio. So definitely, if you expect the interest to be rise further, then better you get rid of your trading portfolios now. Or when you acquire your trading portfolios, you have to be mindful what trade you should absorb. If it is for trading purpose. Now I am referring always trading, because there is no market risk if you hold it in your investment portfolio, right? Always remember, the market risk is related to your trading portfolio. Now let's say you purchase 100 billion treasury bonds and you are not going to trade it. You will wait, let's say those treasury bonds mature in 2030. So you don't have any market risk, right? If it is only in the trading portfolio, right? Clear? Or
Yeah, thanks.
so let's move on to the next area. What is enterprise-wide risk management? Right? Okay, before we start, any more further questions on the points we discussed before the tea break? Any more clarifications? Okay, if not, then let's move. So now we move on to the more important, widely discussed topic called enterprise-wide risk management. I think all of you have heard in your business environment, business operations, day-to-day business operations, enterprise-wide risk management, or in particular to a bank, bank-wide risk management. In a short version, we call ERM. Okay, so what is ERM? So there's a definition as per the COSO. Now, COSO is a famous organization called Committee of Sponsoring Organizations of the Trade Bay Commission, USA. So according to their definition, ERM is a process effected by an entity's board of directors, management and other personnel applied in strategy setting and across the enterprise, designed to identify potential events that may affect the entity and manage risk to be within its risk appetite to provide reasonable assurance regarding the achievement of entity's objective. So if you look at this definition, there are a number of important things highlighted here. So if you go back to the last part, it's a sort of action plan which provide reasonable assurance regarding the achievement of entity's objective. So one of the most important thing in this risk management framework, ERM framework, is to set the objective. So we look at them, look at each one of them later. So you have to be very clear about your objectives. So without which you don't know where you are going, right? Then another important element is a process affected by entities, board of directors, management and other person. It's not just the board of directors alone. Now, if you look at many other aspects, usually the board make decisions and management implement. But here, this is a process affected by entities, board of directors, management and other person. It may go even below the line. And it is across the enterprises. And managing risk within the appetite. So it's a broader definition which covers many aspects. So in more general terms, enterprise risk management is a process ongoing and flowing through an entity. So this is not something static, stopped at a particular time. This is an ongoing process. Now you can't, because of you set a framework, you can't stop at that point. Now no one can say, I developed a risk management framework in 2017, I am fine. You can't wait like that. It's ongoing because the new risks come, existing risks move away. So you have to adopt new strategies. The existing strategies may not be acceptable. So it's ongoing and flowing through an entity, right? Affected by people at every level of an organization. Remember, the first part I mentioned, management, directors, management, others, personnel. So every level, including line managers, get involved because they are the people who directly knows about risk at line levels. Without their help, without their knowledge, top cannot decide on what to do. So applied in strategy setting, because this base work helps to set the strategies of an enterprise, right? Applied across the enterprise at every level and unit and includes taking an entity level portfolio view of the risk. So the importance of an enterprise risk management until this ERM framework introduced, there was a diversified risk management framework within business organization. So it's basically every unit, business unit has its own risk management framework. So why it is important to have an enterprise at risk management? Then all these risks among the business unit can be aggregated so that broader risk management approach can be taken. Designed to identify potential events that, if they occur, will affect the entity and to manage risk within risk appetite. So it helps to identify the potential event. If they will occur, will affect the entity and to manage risk within its risk appetite. Or able to provide reasonable assurance to an entity's management and board of directors geared to achievement of objectives in one or more separate but overlapping categories. So when you have overall objectives, and when you have ERM, then it gives a reasonable assurance to the management and board your ability to achieve the objectives, right? So in a general ERM framework, we usually discuss about 8 components. So these are interrelated. Internal environment, objective setting, event identification, risk assessment, risk response, control activities, information and communication, monitoring. Right? So let's look at one by one. Okay, this is again a graphical way of what we discuss. Establish the contents, identify the risk, analyze the risk, evaluate the risk, treat the risk, and on the other side, communicate and consult, monitor and review. So it's again another way of looking at risk components from the establishing the context. Okay, let's go to one by one. Internal environment. What is the internal environment? The internal environment encompasses the tone of an organization and sets the basis for how risk is viewed and addressed by an entity's people, including risk management philosophy and risk appetite, integrity and ethical values, and the environment in which they operate. Right? So before setting or developing an ERM, most important thing is to identify the internal environment in which it operates. Because all the rest of the things to be developed depend on the internal environment in which you operate. Right? So, what sort of things you look at? The tone of an organization, how the people look at risk, what is the risk management philosophy and risk appetite, the integrity and ethical values of the business entity and individuals, and the broad environment in which the business operates. So these are very important, because depending on these level of these, different areas, then probably the risk management tools may be different. Now, if you take risk appetite, we will look at example later how different businesses look from different way in the same industry. Okay. Maybe philosophy, there are different philosophies. Even if you take two banks, maybe different approach, different markets they target. Maybe one bank may very risk averse, they may target a particular group for lending only particular group. But there is another banker who may target a little bit riskier group. Right? Because philosophy, appetite may change. Okay? Objectivity. The objective must exist before management can identify potential events affecting their achievement. This is very important. Before you set up the framework, you must have objectives in place. So what things you want to achieve and what events can affect the achievement. So ERM ensures that management has in place a process to set objectives and that the chosen objectives support and align with the entity's vision and are consistent with its risk appetite. Right? It's again important. Set up the setting of the objectives and which is aligned with the entity's mission and also consistent with the risk appetite. Now, all this objective has to be set within the risk appetite. Then next element, event identification. So internal and external events affecting achievement of an entity's objective must be identified, distinction between risk and opportunities. So then you have to identify the events which affect the entity's objectives, achieving an entity's objective, both internal and external. Right? Possible internal and external. And also the opportunities. Now, sometimes, when we talk about risk, there may be risk in the sense there's a positive side of things also. That is potential risk that could end up in a gain. So once you identify the opportunities, you must channel back to the strategy. Because those are, good for the institution to do better or have a better profitability. Okay. Then risk assessment. Risks are analyzed considering the likelihood and impact as a basis for determining how they should be managed. The risks are assessed on an inherent and residual basis. Now, so once you identify the risk, then you must analyze. So in a normal business entity, there may be hundreds of risks you identify during a risk ERM process. So it is very difficult for you to manage all those risks, because as I said, risk management is not free. It comes with a cost. So how do we do that? Through a likelihood and impact analysis. We will look at that. And then we have to identify inherent risk and the residual risk. Okay, so it's very important. What road do I take? Somebody asks, what road do I take? Well, where are you going? Other person reply, I don't know. Then it doesn't matter. If you don't know where you are going, take any road. It may be a difficult road, it may be a costly road. So that's why we need to identify where we go. Okay, where we go. Then we can decide the right path. You should go there. So now this is a, risk assessment, metrics using impact and likelihood. So what we do is we build a risk matrix. Now this is a 3x3 risk matrix. Now this is another one. So you can build any type of risk matrix depending on your way of thinking. Now, for example, now here, one way of thinking is management thinks there are 3 categories of likelihood: low, medium, high. Then again, management thinks there are 3 possible levels of impact: minor, moderate, significant. So 3 possibilities of likelihood: low likelihood, medium likelihood, high likelihood. Then on the impact side, minor impact, moderate impact, significant impact. Now, what do you mean by low likelihood? What do you mean by low likelihood, or what do you mean by high likelihood? What do you mean by low likelihood? What do you mean by high likelihood? Anyone? Any thoughts? Low likelihood, high likelihood. Any guesses?
There is a lower chance of occurring that event, and there's a higher chance of occurring that event.
So low likelihood means there's a lower probability of that event taken place. So that is a possible risk event, but probability is very much less. Then there may be another event. The probability of that event take place is high. Okay. Then what about minor, moderate, and significant?
Gain or loss for the business is larger or smaller?
Yeah. So if the particular event take place, what is the level of impact? If the impact is lower, then it is a lower probability, it's a minor impact. If there is a higher, greater probability, then lower, then moderate. Then there's a significantly high probability of impact, then it is a significant. So this is a way of looking at the different risk events. Remember, so this is part of your risk assessment. So what you do is, now when you identify the risk, you put all those risks into these grids. Now here you have one grid, sorry, 9 grids, 3 by 3 matrix. So then if you just look at this grid, now what do you mean by, now let's say you are a risk manager. Now it says any risk event in this particular grid, now forget about this one, accept risk. What do you think? What is your view? The probability of that event can happen is low. If it happens, impact also low, minor. Then as a risk manager, what do you think? How do you think about that risk, a particular risk? As a risk manager in your business, now let's say in your bank, you are the risk manager. And you have been asked to do the assessment of risk events and put it into the risk matrix. So you have identified 105 risks, and there are 3 risks based on your probabilities for likelihood and impact in this particular grid. So what do you think? What is your view about such risks? Before I come to explain these things, I need to know what. How do you think that?
Though it's very low and accepted risk, but these things may lead to a high risk.
Forget about what is written here. Your view of such risk.
Whether it is a low risk also, we can't just evade because it may lead to a very high risk if we avoid this, or even we didn't look into very carefully.
Any thoughts? Any other views?
I think it's okay to take that risk, and we don't need to prioritize that category of risk for our business.
Okay, why do you think so?
Because the chance of occurring the event is low, and the most important thing is that impact for our business is very low.
Very low.
So we don't need to prioritize.
Okay. So I think you came to a very good point. Now I said 105 risk events. Now if you look at your bank, you may have 1,000 not risk event. So you can't manage and control each and every risk. So your objective is to manage the risk that you should manage in whatever manner. So that is the purpose of risk matrix. The risk matrix tries to prioritize and identify important risks. It's not free. So when you see particular risk event, now here I said about 3 risk events are here in this case. So basically you, based on your quantification, probability analysis, you see there is a lower chance of that particular risk event can happen. And even if it happens, your impact will be small. So that means simply you should not make much effort on managing such risk. Okay, so you can accept the risk. Simply accept that risk. That happens, simply accept, because it's only limited chance, and even if happen, your loss would be minimum. Okay, even if it happens, your loss would be minimum. Okay, so that is the objective of risk matrix. Identify the most important risk that you should concentrate mitigating, managing. So if you look at these 3 grids in white category are basically risk somewhat you are comfortable. So it doesn't mean you need to completely ignore, but at least you should not spend too much time, resources on those 3, because now if you look at this one, even low, moderate. So it is worth accepting, but monitor. Then this is medium, but impact minor. Accept, but monitor. But if you go to the upper corner of your right hand, upper corner, then this light, dark gray, those are the risks you should make full effort to manage. Because if you take this particular grid, what does it mean? The risk event in this particular grid, there's a high probability of happening, and also happen, your loss would be significant. Okay? It's like Delta virus. Okay? So now if you don't wear a mask and move around, there's a high probability of you get infected. Almost 75 to 80%. If you move around, especially in Colombo district, without wearing a mask in a public place, then you are at a high risk. So there's a 75 to 80% chance of you getting infected. Okay. Then look at the controls you have. Okay. Whether you have got the vaccine. Got the 1, 2. You know what has happened in your business. Similarly, just like good example I brought it. Similarly, you are receiving what controls you have in place. Then let's say no vaccines, 0 vaccines. So what do you think? It is here. It is here. High risk. If that happens, impact would be almost death. Significant. Then better manage it carefully. Then have a better management. So if you know there's a higher chance of potential, infect with this virus, and if you get infected, definitely it will be death. Then better have an extensive management. Go out of home. Wait at home. Huh? You see? That's very important. So likewise, you must put an effort on events in your business which are high likelihood happening and moderate to significant, impact. So if you look at those in these three grids are the most risk events that you should concentrate. Then you have the mild gray area, which again you need to have a management. You can't just forget, like, take simple as other, pure white category. Now consider a management required, management effort worthwhile, manage and monitor risk. So you need some sort of management. Okay. But if you look at this category, extensive management, these are the danger zone risks in your business entity. No way you can ignore. You need extensive management. Okay. So that is the purpose of risk matrix. So depending on your business, I don't know why this. Okay. Depending on your business, you can decide on the size of the matrix. Now this is again, this is 5 by 5. 1, 2, 3, 4, 5, 1, 2, 3. So it's a 5 by, earlier 3 by 3. So it's up to you. So if you want to go to very micro level of, identifying this, you can do so, no harm. So that's your philosophy. That's your risk appetite. Now in this case, they have divided into 5 likelihoods: rare, unlikely, possible, likely, almost certain. So it's a different way of looking at it. Then impact: insignificant, minor, moderate, major, most severe. So definitely in such company, they have identified these 5 categories are the critical risks that they should focus on. Then they have other light yellow. Then these are the other second level, they think. Then they have the, dark yellow and light green. So this is the way you look at likelihood impact. It's not just, 3 by 3, 4 by 4. It's up to you, decide. On the maximum level, you think you need to, to the micro level, you think you need to manage. Because large business organizations, these runs to hundreds, thousands, the risk event. Now this again, another way of looking at it, impact. So now if you look at this particular case, so they consider this a 3 by 3. So they have rated from lowest risk to the highest risk. You see, whatever the risk in this block, this grid, lowest risk, then this is the second lowest, this is the third lowest, 4th, 5th, 6th, 7, 8, 9. So definitely such a company would highly focus on 7, 8, 9. Then they will gradually reduce it to, this should be, I think, black. Sorry, this should be black. Right? Then other areas like 4, 5, 6 and highly critical 7, 8, 9. This should be black, right? This is another risk matrix by another institution. Again, likelihood low to high, impact low to high. So they have identified how many, like 26, 27, 28. Now this business organization identified 28 risk events. You see, 28 risk events. Yes, 4, 6, 10, 13, 18. Yeah, 28 risk events. So now each risk event they have put it into a grid. Now only the 28th risk event they have identified is in the lower bracket. Then risk event 25, 26, 27, you see, are the other lower risk. Now, if you look at risk event 1, 2, 3, 4, 5, that is based on the priority, these are the risks most dangerous and you should manage up to 17. So these risk events 1, 2, 3, 4, 5, 6 up to 17 are the most important critically attended risk events. Then the next category from 18 to 24. Then next category 25 to 27. The minimum effort you should put, or maybe you can accept the risk in the case of risk event 28. So this is your job as a risk manager. It's an ongoing process. Now sometimes when you review your analysis, you feel now this number 22, you categorize as a moderate risk event, or maybe this 25, where you did not pay much attention in terms of management, even though you monitored. But during your post-review, remember, post-review, monitoring. During your monitoring, you found that it was more than expected, both in terms of likelihood and the impact. So even into initial analysis, this was categorized as in this grade. Later on, you may realize you may be wrong due to whatever reasons. So what you have to do, then probably you have to move this risk in the following year or following period to the appropriate, it may be year. Sometimes a certain risk which you thought would appear in this level, of course, would have not that serious. So probably maybe you have to reclassify that into this category. So it's a changing process. So that's why I said during your risk management process, there may be new risk coming or existing risk regraded. It may not appear the same, right? So this is again typically from a real perspective, let's say a business local, maybe state institution or maybe semi-state institution who has classified risk in a more broader sense. Now they have said rare once in 2 years, unlikely once in 20 to 30 years, possible once in risk event can happen once in 10 years. Okay, then likely once in 3 years, certain once a year. So this is the classification this particular business would have used. So if a particular event happens every year, possibility of happening every year, so it's a definitely certain event. If you look at, if you take natural disasters events for especially farming industry, now every year you get a flood, every year you get a drought, at least once in 2 years. So if you look at a farming, agricultural industry of a certain products, so this is a almost certain event. You see? So almost now, if you look at every year, there's a drought. Every year there's a flood. For the last 10 years, if you look at every year the flood which impacts certain industries, certain agricultural products or whatever, that is possible. See, every year power cut. So you have to identify the events on your business, on your bank. Then the other classification they have mentioned here is anything below 100,000 impact, then 100,000 to 500,000 unacceptable levels of complaints, then 500,000 to 2 million reported in local paper, reported in national press, reported raised in parliament. So this is probably a state institution, how they look at. So up to this level, no action. If it is something that can happen once in 20 years and loss is very low, then no need. So if you look at this one, immediate action needed, serious threat to provision and or achievement of key services or duties. You see, so this is a way of practically anybody looking at it in your business. Okay, let's look at risk response. So now you know risk prioritization through the metrics, then risk response. Now management select risk responses avoiding, accepting, reducing, and sharing. So basically, there are 4 ways the management can look at risk once you identify and prioritize, avoid, accept, reduce, or share. Slide explaining that. So what do you mean by avoid? What do you mean by avoid? What sort of risks you should avoid? What sort of risks you should avoid?
Risk
Anyone?
with high chance of occurring and risk with high impact that we discussed earlier.
So if there is a risk that can happen with greater probability and impact also significant, and if you want to manage, you need to expend significant resources, no point of doing that, except in that event. So you must try to avoid. You must try to avoid. So can you give a, actual, real life, I mean, not a banking example. In the recent, last few, maybe week or so, we had some experience. Internationally, can you give an example of such event? I'm not referring to banking. Can you think of such an event you should avoid? Normal general example I'm asking, anybody can think of. Somebody offer you a free tour to Afghanistan, Kabul. So what do?
Will avoid due to the
Avoid.
bomb blast.
Are you going to manage it?
No.
No way of managing, because risk is very high. So better avoid, don't go. The impact the probability of some bad incident happening is significantly high. And if it happens by chance, the impact also significantly high. So a very straightforward, very simple example. So there may be many more events in your business operations. You know, there may be a, I don't know whether I'm telling right or not, but I can think there's a, you get a request for a credit facility from a politician notorious. Very simple example. What do you think? Are you going to manage the risk or avoid the risk? I think I am avoiding risk. Even though he provides security, anything, I am seriously doubt whether the bank can recover it. Okay. So there may be many events like that. In your day-to-day, business life, banking life, in granting credit, in making investment, okay, in maybe certain operational matters, okay. Okay, now if you take fire, even an operational risk event like a fire, damage to building, system hacking. So these are possible risks. Now, what is the latest system hacking we saw, not in a bag? Anyone can tell. System hacking. Very latest event in the country. These are the risks we need to think of. Huh? Anyone? If you listen to the media, read the media, listen to news, you should. That's the other thing I want to mention. I mean, in financial world, you must read what is happening around the world with respect to your operations, businesses. Then only you can find out risk. Any recent event?
To a telecommunication institute
Huh?
recently? To a telecommunication institute?
What is that? One I was thinking of different, but I don't know whether this one what is that?
To telecom, I think recently they have a cyber attack. I heard about that.
Sri Lanka Telecom?
Yes, SLD.
When? Yesterday?
No. Sometime back, I think.
No, I am referring very recently, couple of days ago.
Some Twitter accounts were hacked. Politician.
Haven't you heard that, what you call drug, medicine, what is called standard institution, what you call pharmaceutical, mRNA or whatever, their database was lost. Have you seen medical, some, authorization, drug, what you call in Sinhala, Aushadha Nivamana Adhikari. That was the hot news last 2 days. No backup, as per the news I saw. Haven't you heard about it? It was in the media news last 2 days. They lost the database, and which is one of the critical databases as it appears. That was the news yesterday and day before. So basically, that's a significant risk. Now, let's say your loan database hacked and no backup. What are you going to do? Significant issue. Your deposit database hacked. What are you going to do? So these are operational risk events, not the credit risk. So they are, what they say is only 4 people knows the password. As per the media, only 4 people know the password. You see? And it is located in a very safe place either. So as per the media, this was, I'm just telling what was mentioned in the media. So let's say you're a bank. Sometimes your, own employee can do something, critical and hack the database. So these are the risks. So it's very important to identify what thing you should do it, what thing you should accept. Now, what sort of risk you should accept? What of risk you should accept generally? Risks that can happen with a low probability, and even if happens, impact is low. So you don't have to worry much. So simply accept it, and if that risk happens, take that into your books because it's very low. No point, spending resources. It's like a vehicle you keep in your yard for 365 days. Some people vehicle, it's only in the vehicle what you call it, garage. In your own garage, the vehicles are therefore they never take it outside. So it's better to accept. By chance, one of the days in the year you want to go, still accident could be possible, so better accept it. Don't insure it because almost 364 days of the year it is in the garage. You never take it outside the garage, except for maybe washing or cleaning. So there are vehicles like that. I know people. Only 5 days of the year they take the vehicle out. So why you spend 500,000, 200,000 on insurance? So accept the risk. So similarly, your business, there may be certain risk, probability low, impact low. So accept, no point spending resources. Then reducing or managing. So these are the risks which you have to be very careful because you have to initiate those actions. You can't complete your void. Now, classic example is your lending. Even for certain category of people, there is a probability of default, but you have to lend. Otherwise, you don't have any business. But manage it through different risk management. Then sharing risk. So can you give example of sharing risk? I explained earlier also. How do you share the risk? Any thoughts? Sharing risk?
Syndication loans?
But risk is there. This risk is shared among all parties, but it is a risk pooling. But how do you share the risk? Because even syndicated led, all parties has to bear the risk. But insurance is one way because now, for example, especially the operational risk matters. Now, typical now cash risk in transit, you get a cash in transit insurance.
Investment portfolio?
Sorry,
Investment portfolio?
I couldn't hear.
Investment portfolio?
Investment.
Oh, portfolio. Various investment. We invest various.
To answer, I can't get your voice very clear. But anyway, okay, you may be trying to say something right. Anything that you think through other party like insurance, now for example, fire insurance to the building. So there is a possible risk that your building may get catch fire. So then insurance will basically you pass your risk to the other party. Because here somebody will look after. But the other thing is syndicated loan, you can't pass to the other party, but it's you divide, you minimize your risk, level of level of risk you share, divide among parties. But here the bad events happen, definitely, you will be looked after. Now even property, title insurance you get when you give a loan. So that's a sort of a risk sharing. Say that you give a loan against a property, but there is a problem with the property. Then better you get a insurance, what you call title insurance. So if something goes wrong, the company of the bank, the customer default, you want to sell the property, but there is a title issue comes up, then you will be protected through the what you call title insurance company. So these are typical ways that you can look at risk and take measures, but depending on the tolerances and risk appetite. In control activities, policies and procedures are established and implemented to help to ensure the risk responses are effectively carried out. Okay, so you need to set up policies and procedures so that risk responses are effectively carried out. Okay. So now, for example, certain risk control measures, typically you find in your banks. One form of risk controls that can be commonly observed in banking business is to set risk limits. Risk limits are a tool for both authorizing and controlling specific forms of risk taking as given below. The investment limits, dealing limits, credit limits. Okay. Specification of type of investments and limits. Setting minimum credit ratings. Now, when you want to invest, there is a policy saying, okay, you should not invest anything on a financial instrument issued by or the rating of a company which is below A minus. Only invest in A minus and above. Sometimes you have geographical location, region, country, currency. When you see a particular region is bad, then you must say, okay, your limits to this particular. Now, these are very important in international banks because international banks, they spread over all over the countries, all over the world, and even in a country widely spread. And they sometimes deal in different currencies also. So then there may be limits. Then dealing trading limits on different instruments, especially foreign currency. Probably, how many of you are working in a treasury front? Anyone working in a treasury front? Back office? Sorry, middle office? Anyone has worked or worked in a middle office of your bank? No one? Okay, so let me ask, which area you work in? Are you all in credit? Are you all in other business operations? Okay, if you look at front office operations, net open position, if you are dealing in foreign currency, so you are given a net open. This is the position you can open, keep open. Okay, because to minimize the risk. So if you have excessive net open position, you are subject to significant risk. So there is a limit because of the exchange rate fluctuations. Intraday limit. So within the day, there is a limit. Overnight limit. Up to next day. Dealer limits. So again, counterpart now. When you deal with the other party, counterparty, how much limit? Each dealer in your bank having different limits. So A has this limit, B has this limit. Then if there are adverse movement, there is a level of price that you should cut, stop loss, should stop the loss. Then value at risk limit. When we discuss value at risk, we will look at what is value at risk. So there are so many limits. These are, in fact, broad controls in place, the control activities. So if you are in credit, you know approvals and disbursement limit, sector-wise or geography-wise limit, single borrow limit. This is something coming from the regulator. So there are a lot of controls at different levels to minimize the risk. So what is inherent risk and the residual risk? Now, inherent risk, of course, you can minimize through controls and mitigation. The risk on the face of a particular event. So if you apply appropriate control measures, you can mitigate. But there could be a risk still remaining after applying controls. So that is called the residual risk. Okay. So your task will be to control inherent risk as much as possible, but still there may be a marginal risk remain even after applying controls. Okay? It may not be possible completely to remove. So then information and communication, the relevant information is identified, captured, and communicated in a form and time frame that enable people to carry out their responsibilities. Effective communication also occurs in a broader sense, flowing down across and up in the entity. So there should be a greater communication at all levels, from top to bottom, bottom to top, and across different levels, so that you can identify the issues, concerns, and again set to the new framework. So monitoring the entirety of enterprise risk management is monitored and modifications made as necessary. The monitoring is accomplished through ongoing management activities, separate evaluations of both. So the communication and monitoring is the last two important tools of this entire ERM process. Any questions before we move on? Okay. So now when you set up your framework, remember I mentioned your attitude or appetite is very important. Yeah. The risk management philosophy and risk appetite. So this is one of the important tools in setting up the overall process. Now even objective setting, entity's mission are consistent with its risk appetite. What is this risk appetite or attitude means? So the company's attitude towards risk determines the extent to which its management will accept the risk in order to achieve its cooperative objectives. So that's what I mentioned. Different, same business, different organizations look at risk differently. That is attitude or appetite. So we can't simply say this one is right, this one is wrong. Right? So we can't simply say this one is right, this one is wrong. Because that's appetite of that. For example, if you take two cricketers, how they score. Look at famous cricketer Arvind Silva. the way he is caught is different. But he may get caught also. But his appetite is that. He consider a different way of scoring with a full shot or whatever. If you look at Jayasuri, it's a different way. Total different way. So he doesn't want to, stay in the middle for long. He take the risk and pull all over, hammer all over. So it's his attitude. He doesn't care whether he get caught or not. He pull all over, offside, leg side, everywhere. But if you look at some other players like Sangakkara, his attitude is different. You see how they perceive the risk. But ultimate objective may be same. Now, Jayasuriya want to score 100 or 50, while Sangakkara also want to get 100 or 50. But they don't adopt the same approach. But both achieve. But for me, when I look at, I will see, oh, why, what the hell this man is doing? He's taking too much risk. But from his point of view, he looks at differently. So likewise, each business organization look at the risk differently. Okay, so that is called the risk attitude. Now take an example. Consider the example of two companies A and B in the retail industry, each with large chain of stores operating in Sri Lanka over the last 10 years. Even though two companies are well known in the local market, they do not have business outlets operating in foreign currencies. So both are in the similar industry, retail industry, large chain of stores operating last 2 years. So both are in the same industry, being in the business for last 10 years. But none of them have no operations in the foreign markets. So only confined to the domestic market. So they are known in the domestic market. In order to boost sales in the medium term during next 5 years, each company has set out some strategies. So what are the strategies? The company A targets a sales growth of 20% annually during next 5 years and expects to adopt a strategy of expanding its local retail outlets with small size network, significantly covering all the region in the country. Company B, which also targets a sales growth of 20% annually during the next 5 years and expect to adopt a different strategy of expanding its business to overseas market by setting up few large outlets in selected foreign country. You see? So, what is same here? What is different here? What is the similarity and what is the difference?
Sales growth are the same, but target markets are different.
Okay. The strategy now, if you look at the objective is same. Objective is both expect 20% growth over next 5 years. But both are in the same industry. Arvind and Sanat. Both want to ensure they score 50. Okay, so ultimate objective, Arvind also to score 50 and Sanat also 50. Both are good batsmen. Same, industry. So Sanat adopt a strategy, hammering all over. But maybe Arvindo, maybe let's take Kumar. Kumar take a different strategy to adopt the same, achieve the same objective. So they have one objective, different strategies. So which derive the strategy, the attitude? because company has maybe a different, we look at later, different attitude over the company B. So which company you think would like to take a higher risk through these strategies?
Company B,
Company B, why?
because company B is willing to expand their business to overseas, while
Yeah, so why you
company
say risk?
because there may be larger loss also related to this decision.
Yeah, no, yeah, that could be, that's right. But what is the reason that? Because they are not doing any business right now, isn't it?
Yeah,
But
you
they
are right.
don't know the market appetite. But at least the local industry, they know the market. What is the risk appetite? You know what? Now, let's say, for example, now here, just say garment industry. So here, at least with the retailer, know what sort of garments, what is the fashion here in Sri Lanka, which color, you know, whether it is different if it is ladies what you call garments, there will be different fashions and all that people like. But overseas market, they would have done a research, and of course before investing they would have done a research, but little bit difficult. Okay, so they have to compete with the already established competitors, but still they love for it. Okay, so it is obvious that both companies need to accept some risk when expanding the business, whether in the local market or foreign market. So even the company A, even in local market, he may not be able to capture the market, even though he expect to expand sales by 20%. So both market there are risks, no doubt. But the strategy may be more riskier, appears to be more riskier than company A, since the ability to survive in the overseas market depend on several market, economic or other specific factors relevant to each country. So this does not mean that the company B may not be successful in implementing its strategy, right? So this does not mean it is failure or not successful. So, but the strategy of company B associated with a greater uncertainty. That's the only thing. So this is a clear example of a different risk attitudes of management of two companies engaged in same business. Sometimes these attitudes of corporates depend on the individuals also. Now, even in same bank, you see, suddenly, subordinate talking, now, you sometimes in your words you may talk, yes, now our new boss is very much, good leader than the previous boss. Okay. Now, boss wanted us to give more loan, more risk. Whereas the previous boss never gave a loan to anybody. He's very serious about risk. So this can happen. Even in the same entity, the two individuals may be looking at differently. You see? So it's very important to clearly identify the risk attitude in setting the framework. Okay. So there are different risk attitudes. An attitude is, okay, let's look at what is risk averse attitude. Give me a minute. So So if you look at the different types of risk attitude, first is the risk averse attitude. Now, what do you mean by risk averse attitude? An attitude is said to be risk averse when the decision maker will prefer an option offering the same return for a lower risk, or an option offering higher return to the same risk. So if there are two options, both give same return but different risk. Same return, different risk. Then averse person would like to take the event which has a lower risk. Or there are two events have the same risk but different returns. Okay, so then he would prefer for the same risk which is higher return. So such a business or individual or risk averse attitude. Now we'll take example. Now a company wants to undertake a project which gives the best possible return with minimum risk. The company knows there are 4 projects available in the market, A, B, C, or D, with different risk return combinations. However, the company can undertake only one project due to its limited resources at present. So there are 4 projects in the market with different risk return combinations, but company knows that it cannot undertake all the projects because of it doesn't have adequate resources. So they need to take only, or they need to identify one project. The 4 projects, the project A give expected return of 9, risk is 6. Project B, 10 and 11. Project C, 10 and 6. Project D, 11 and 8. So let's say your bank is looking at a maybe project, maybe infrastructure project investment, which you need to invest about 100 million. And these are the different, projects, 4 projects of infrastructure, which has different risk return numbers. If you are, and you can only invest in one project because you have only 500 million allocated for this particular infrastructure projects. If you are a risk averse investor, which one you select? If you are a risk averse investor,
Project C.
look at the definition. This is the definition. Attitude is said to be risk averse when the decision maker will prefer an option of same return for a lower risk or higher return, or option offering higher return to the same risk or lower risk. Yes. Option C. Any others?
Project C.
Oh, why do you think C? What is the reason you select C?
Because
You get a return of
when we look
10%
at
for a risk of 6%.
Yes. Can you explain it again, please? Because two voices came one together. I think we can give an opportunity to the gentleman first.
No, ladies can go first.
Oh, lady can present because we give preference to the ladies.
when we look at the risk is minimum in project A and C.
Yes.
but the expected return is higher and the risk is minimum. In project C, the return is 10 and risk is 6.
Okay.
Then we should select project C.
Then what about B and C? If the same
B
return,
and same return. In B also same return, but the risk is higher.
risk
So a
is
risk averse company will prefer
lower.
less risk. Yeah, lower risk.
Okay. So it's
Therefore,
perfectly matches with our definition. Okay. So risk averse. Now let's say definitely if you are the bank who want to engage in the project financing and your attitude is risk averse, definitely you would lend for this project C, because for the same risk level it will give you a higher return, or same return level it will have a lower risk, right? So your bank is a risk averse. Your objective is risk averse attitude. So then you will lend to project C. Okay. Then so this is how a risk averse decision maker would look at. He will prefer project C to A because it offers a high expected return for the same risk. He will prefer also C to B because it offers the same expected return for a lower risk. Okay. Right. So if you are now this is risk averse is a one category of risk attitude. If you are a risk neutral, what will you do? If you are risk neutral, so if you are a risk neutral decision maker, you would select the project with highest expected return, regardless of risk, because you are neutral to the risk. So which one highest expected return? You are neutral. You are neutral to the risk. So you will go for the highest return project. So if you are a neutral investor, risk neutral decision maker, you will select the project A. Now the next category is risk lover. So your bank is a risk loving bank. No, there are banks like that. There are bank managers like that. I mean, there's nothing wrong in it, but different attitude. And generally, many, investors are risk averse. Even in any market, financial market, even individuals, there are risk lovers. So if you are a risk lover, which one you select? A, B, C, D.
D.
B. D.
Yeah.
D or B? Dog. David.
D.
David.
Yeah, D.
D. Tell me, I can't hear B or D.
Yeah, D.
David.
Yes.
Okay. Anyone else?
Yes, D.
B.
D for dog.
D.
Yeah.
D for dog. Okay. Anyone else? Any other, risk lovers? Any other thoughts? So two would like to go for project D. No, all the others are risk averse. Because they are risk averse to tell the answer. Better keep quiet. Or
How
risk
about project
neutral.
B?
Project?
B.
It can D or B.
B.
B. Okay, so there's a risk lover. So different answer. We don't know. Let's see. Anyone else? Okay. No, who is a risk lover? Now, risk lover is a person or entity who would like to take any risk as far as it gives a higher return. Any risk as far as it gives a higher return. Now, risk neutral is he is not considering risk at all, simply look at the return perspective. But risk lover would look at return as well as risk. He looks at both. He looks at both. So, out of these projects, which one could end up with the highest possible return?
D. D for Davy.
D. Of course, expected return is 11D, right? Okay. Okay, expected return highest is D. But you have to couple with the risk. Now, expected return is in a standard normal distribution, X bar mean average. Risk is the standard deviation. Right? Risk is the standard deviation. Now, expected return means standard normal distribution X bar. You know, mean distribution. This risk is the standard deviation. So, take A expected return means expected average mean is 9. Now, it's like there are 5 students. Okay, 5 students. They sit for the exam, one get 50, other get 60, other get 80, other get 100. So when you take all 5 and divide by all 5 together and divide by 5, average is 70. So that is the mean, that is the expected return, mean. Then we compute standard deviation. How much each one deviate from the mean. So that is the risk. So if you take A, the average expectation is 9, but it can go either side by 6. Right? It could end up with maximum 15. It could end up with worse 3. Right? If you take B, the mean is 10, standard deviation is 11. It could end up with 11, 21, or it could end up with -1. So the project A, the range of return could start from 3 to 15. Project B, return could vary from -1 to +21. Project C, return could vary from +4 to +16. Project D, the return could vary from +2 to +19. Right? So if you take expected return coupled with risk, because risk lover would like to take the maximum risk possible. He doesn't care the risk. But as far as that risk give a higher return, he will take it. He's not worried about the downside. Okay. So if so, risk lover would take which one? Which one he would take? A, B, C, or D?
D.
Huh?
B.
B. Because, okay, I love the risk. I'm not looking at the downside alone. I am looking at the high side. So, by taking the project B, if everything goes fine, I will end up with a 25% maximum return. So I will keep a bet because I'm a risk lover. This is like, somebody tells you, okay, you go to top of Pidurutalaga and I will offer you 100 million rupees. Jump from, Pidurutalaga to down, 100 million rupees. And let's say, take a different example. So there is a, about 7,000 feet height rock near the sea. Near the sea, somebody tells you, okay, go to the top of the rock, 7,000 feet height, and jump to the sea. Is there and 100 million rupees? Or maybe I'll make it 1,000
Thank
million.
you.
1,000 million rupees. 1 billion. So how many of you take that? How many of you take that choice? Tell me. Will you take that? Any one of you?
No.
I don't think many of you take. So there's a greater risk there. Risk is highest. But by chance, you got it right, you end up with 1 billion. Return also high. So risk lover take both risk and return into account. He weighs both. He weighs both and take the decision accordingly. So risk lover would definitely go for project B rather than project B. Right? So this is the risk attitude. Now the same even in lending, this can happen. Now, for example, a particular customer comes to a bank, let's say bank A, okay, the bank A say, very sorry, we can't give you 100 million loan facility for your business. Okay, so I go to the bank there is a little noise coming. You can switch off the mic, then it's clear. So let's say I go to a bank with a project report, which I need 100 million rupees for my project. So bank A say, after analysis, oh sorry, very sorry, we can't offer you the loan, whatever reasons they see as a risk. Then I go to next door bank. Next door also there's a bank. Let's say it's commercial bank, then other door is Elan bank, or maybe international. I go to that bank and I will give the same project report and same information, and they say, okay, I will give you the loan. So what is the difference? What is the difference? I went to the commercial bank yesterday, gave the report, and they say no. I go to international bank today. I'm just taking example only. Give the same report, and they say yes. So what could be the reason? What is the reason?
Risk attitude.
It is the way, risk attitude, or risk, way of looking at the risk between the different banks. I didn't change my report. It is the same report I presented to both banks. It is same myself, I went there. So nothing has changed between the two banks. It's me, it's my report, it's my project. So the commercial bank look at differently to HNB. HNB look at different to commercial bank. So that they set their attitudes. So that is an important fact. Now, when you set up your framework, there's a great deal of risk attitude work because all these risk management techniques depend on risk attitude. All these control measures depend on risk attitude. Even setting limits based on the risk attitude. Right? Any questions so far? So let's start on this one, but we can't complete today, but let's have about a couple of slides. Now, the relationship between corporate governance and risk management. Now, if you know issues of risk management and corporate governance, as you have seen, experience, they are interconnected or closely connected. Okay, so whenever you talk about several risk management failures, you have to talk about corporate governance failures and issues, right? So interest in matters of corporate governance has have grown during past decades with development of principles of corporate governance and codes of best practices. I think over the last 20 years, prominence has given to the area of corporate governance. It is not just, automatically came, it is by looking at the past experience. Because when many international failures were looked at and analyzed, it was found many failures have occurred due to poor risk management and poor governance. So these go together. It's like your left and right hand. So these go together, risk management and corporate. So that's why in this particular course we have a session on corporate governance and it's linked to the risk management as well. Okay. So the necessity for change began with number of significant and well-known corporate failures. So the obvious questions that are asked when a company collapses unexpectedly. So these are the things, because generally the problem in many corporates, you think everything is smooth. Things will be smooth when overall environment is smooth. Okay. So because of that, people are not adequately prepared to face the risk. So they think there are no risks. Even if there are risks, they are very minimal, so we can have a comfortable life. We don't want to mitigate risk, and so on. Now, even if you look at our own Sri Lankan experience, even some leading hotels, when the COVID first impacted, or even before that with the this 2019 attack, when hotels were impacted. Subsequently with COVID, then tourism, impacted. Even big hotels under big groups did not have adequate, sufficient buffers to run the businesses. You see, it's pathetic. If you look at normal times of business, the rates they are charging, they are occupied, their rates are very high, but they couldn't survive even for a couple of months. They didn't have adequate liquidity, buffers to meet even their operational expenses. It is pathetic. So it's all risk management failures. Because generally everybody thinks everything is beautiful when things are moving comfortably. But no one can no one thinks of an uncertain event that could take place anytime. He never knows. So we have to be ready. So then things happen. The natural questions ask, why did it happen? So we are doing the postmortems. No point in doing postmortems. So rather than postmortem is reactive. You take reactions after the event. But be proactive. Take measures to prevent that happening. So then you should ask, what should have been done to prevent it? Why I did not do this? What should be done to reduce the risk of it happening again? So what measures you can adopt to stop it is happening again? So these are the possible questions that somebody would ask when something happens. But as risk managers, rather than answering questions once it happened, you should have a system in place, those things not to happen or minimize impact if it happens. So that is part of your corporate governance. So whenever you establish clear corporate governance structures, you can protect your bank or institution or minimize the risk arising from even unexpected, uncertain events. So that is the job of corporate management under a corporate governance and risk management framework. Okay, so I think we can stop there and we can start next day moving further into this area and also for maybe the new module following week. Any questions? Anything you need to clarify? Okay, so if you don't have anything, we'll stop here. So we'll see you all next Sunday at 8:30. Okay, thank you.